In this video, I'm going to go over the accounts receivable and allowance for doubtful accounts for stock market in its 5th month of business. So to start, I want to go through looking at the general ledger and explaining what's happening to this company, stock market. So it started the accounting period with $10,000 of accounts receivable. And it also started with $500 credit balance in its allowance account. The allowance for doubtful accounts represents the amount they did not think they were going to collect of the 10,000 receivables that they had on hand last period or last month. So they thought 5% of the receivables would not be collected. Well, what ends up happening is they have sales on account, you debit accounts receivable and credit sales. And what we also have is where they collect their receivables. And that's showing that here. What I want to focus on now, though, is the write-off. There's an entry here where they were told that 600 of their customers are not going to pay, so they're giving up on them and writing them off. The entry is to credit each of those customers' accounts receivable, which we can do now because we know who they are, and every account receivable has a company's name with it or customer's name associated with it. The debit is not to an expense, it's to your allowance for doubtful accounts. If I can show you over here, we had allowed for those customers to go bad in the prior accounting period. In other words, this beginning balance, to get that balance there, we had to expense doubtful accounts expense. Now what we're doing is we are taking them out of the allowance account because we now know who it is by debiting the allowance and crediting the accounts receivable. The effect on the accounting equation is actually a no effect because the writing off does not decrease your assets and decrease your shareholders' equity. That happened last accounting period when the adjusting entry for your allowance was recorded. And that's what I want to do now. So going back to here, management has receivables. We're at the end of this month. It has receivables of $12,500. And what it estimates is that 5% of its receivables are considered uncollectible. Here's the wording. They adjusted the uncollectible accounts as being 5% of its receivables. Now you'll notice here that this is not the same amount, and that's because, we look back here, that's because last period we had allowed 500 to go bad. What we ended up actually writing off was more than what was allowed for. So we have, in a sense, under allowed last period. We didn't expense enough by 100. So to get to this proper ending balance of 625, which, by the way, is equal to, I'll prove it here, it is your 5% times the receivable. So in these adjusting entries, management's telling you what this needs to be, the amount of your adjusting entry, which is a debit to doubtful accounts expense, which makes shareholders' equity go down, and the credit is to the allowance account. And again, we don't know who specifically is not going to pay, hence we have to credit the allowance account instead of the accounts receivable account. After you make that credit to your allowance account, it'll have the proper balance, or the balance that management wants in it.